Welcome to the Crypto Layer HQ. Today I will be going over when the soonest we could bottom in this bear market. So if we look back in 2022, we can see that we had our bottom in November of 2022, but we can also see that back in June of 2022, we almost bottomed as well. And from the top, that took approximately 221 days. This wasn't the exact bottom, but it was nearly the bottom. We did end up going lower, but only by about 13%. So you could argue if we didn't have the FTX collapse, which gave us this drop in November of 2022, that perhaps we wouldn't have gone lower, and this would have been the bottom in June 2022. So assuming that this could have been the bottom and where most of the weakness ended up stopping, and then we eventually consolidated and went sideways, if we didn't have the FTX collapse and went lower into November, then this could have definitely been the bottom, and that would have been 220 days from the top. So if we measure that out from here, from the current top, 220 days would take us to May of 2026, which is not that far away. If we look from now, that is about 80 days, so 2.5 months. From now, the bottom could potentially be in, and we then end up consolidating, going sideways. I would say it would be more likely that the bottom is in is if we continue to see aggressive weakness over the next couple months into May. For example, if the drawdown by May is, let's say, 70% or even 65%. So let's say we're anywhere between mid 30s to low 40s by May, then that definitely could end up being the bear market bottom. Bottoming in May wouldn't be my base case unless we end up dropping significantly more below the 200-week simple moving average and end up in the low 40s or even high 30s. But it is something to keep in mind that if we do go significantly lower into May, that might end up being a good point to start dollar cost averaging, the same way that back in the 2022 bear market, that once we did have our initial bottom in June of 2022, we did end up going sideways, and this was a great point to start dollar cost averaging, even though we did end up going lower in November of 2022. If you did have a time horizon of dollar cost averaging for at least the next year to year and a half, so let's say you started dollar cost averaging at around this low and spent the next 365 days dollar cost averaging, you would have bought along this entire section. You would have spent a good amount of time DCAing at the bottom, and you would have gotten at very good prices. Even if you did end up DCAing even longer, let's say you want to take on less risk and you spent, for example, the next even 500 days dollar cost averaging, you would have gotten most of the bear market, and you would have dollar cost average at great prices, and you wouldn't have taken on too much risk since you would have dollar cost averaged over an extended period of time. So what I will say, there is nothing wrong with dollar cost averaging a bit early before the bottom is in, but it is important to keep in mind how low we are from the top. So for example, when we were here in June of 2022, from the top, we had already gone down 74%. And the bear market before that, we had gone down 83%. So being down 74% from the top with diminishing returns was a good amount of drawdown to warrant DCAing, since there was a good chance that we weren't going to go significantly lower. And that was the case since we ended up only going down 77% from the top as opposed to 74%. So we only went down 3% more when measured from the top. So it didn't make sense to risk this not being the bottom and waiting to bottom later in 2022, since that might have never happened. And we could have, of course, easily just ended up consolidating, maybe going higher, and then you would constantly be waiting for a lower low than what you had in June 2022. And then maybe we did end up have pullbacks. But if you keep waiting and waiting, eventually you could end up missing the entire bear market. So it is important to have a plan and assume that this bear market we won't drop as much as previous bear markets due to diminishing returns. So the previous bear market we did end up dropping 77%. So let's say this bear market we end up dropping 70%, and let's say you want to take that as your base case, that would be 37K. So once we're down, for example, 60%, so that would be around 49K, for example. If your base case is we're going to drop 70% from the top, if we're already down 60%, it's potentially a good area to start DCAing from, since if you're DCAing at 60% and then we end up going even a bit lower, down 60, 65%, if we don't end up going to your target of 70%, you still ended up DCAing at great prices. And if your time horizon of DCAing is over a year to a year and a half, you will end up buying at great prices and you won't miss the bottom and constantly wait for a lower price and never end up buying, which is a big mistake a lot of people make, since once they see a certain price, for example, let's say we go to 48K and then we start grinding higher and you haven't bought any yet, people start to wait. Oh, we were at 48K, I didn't buy, I want to wait for price to go back to 48K again and I'll buy this time. And then it ends up going to 48K and they don't buy because they think it's going to keep going lower, and then they end up never buying. So that's why it's good to have a plan in terms of when you should start DCAing from the top, what percentage drawdown, keeping in mind that potentially the max drawdown will be 70% considering diminishing returns, as well as what time you should start DCAing. So for example, 221 days from the top, which would be mid-May, so 15 May 2026, 221 days from the top would bring you here, and then which is similar to 221 days from the top, which got us to this bottom here. So if we are significantly lower in May of 2026, for example, down 60%, you could start DCAing from there. And then obviously 365 days from the top, which is often where the exact bottom is, would take us to October 2026. So that could be another good spot to keep an eye on. So if you were to start DCAing in May into October and then even past October till end of 2027, that could definitely be a good strategy. And even if you want to be less risky, you can even start to continue DCAing into, let's say, Q1 of 2027. So that would be end of March 2027. So around here. So for example, you could start DCAing in May 2026. If we're lower in October, you could be more aggressive and then continue into Q1 of 2027. That way you lower your downside risk as you're not buying all in one go and then risk ending up going significantly lower. So have a plan in mind and keep in mind that we could potentially bottom as early as May and definitely as late as later this year, potentially end of 2026.